Hello, and welcome to the CRI webinar on Qualified Opportunity Zones. Today, we're going to hear from one of CRI's experts on the subject to learn more about this powerful investment tool, and we'll be able to address any questions you have along the way. First, I'm going to introduce Christy and I, and then we'll review some housekeeping items and today's agenda. Christy is a top 25 OZ influencer in the category of tax specialist, according to Opportunity Zone magazine. Christy boasts years of experience working with high net worth individuals, bringing tax planning ideas to the table while also serving in her community. She serves as the board chair of Career Source Suncoast, a local workforce board for Sarasota and Manatee counties, and as an executive board member on the Manatee Chamber of Commerce for Small Business. Christy has helped host 3 panel discussions regarding the information to be presented on this Qualified Opportunity Zone webinar to communities seeking more information regarding their available opportunities. She has presented alongside legal counsel in all 3 basics of the law and how to plan for the investment. Manatee, Sarasota, and Collier counties have all participated, bringing their planning, zoning, and economic development departments to the table to share potential ideas for development and opening their doors to Opportunity Zone investors. I'm going to talk a little bit about Christy from a personal standpoint now. Christy grew up in the Ocala, Florida area and earned her bachelor's degree in accounting from the University of Florida and her master's of accounting degree from the University of Texas, Arlington. She has 2 teenage children, enjoys watching football, and is particularly passionate about her alma mater, the Florida Gators. She enjoys reading and being outdoors and traveling around the country. Beyond her 2 children, Christy also has a 4-year-old Bichon Frise named Chloe and a 2-year-old long-haired Chihuahua named Bella. That's a little bit about Christy. Now a little bit about myself as kind of the moderator of this discussion. I graduated from Florida State University with an undergraduate degree and a graduate degree in accounting and enjoy watching FSU athletics. I too enjoy traveling and recently completed a trip to Spain with my wife and 11-year-old daughter. Like Christy, I also have a dog named Bella, who is a 13-year-old Labrador Retriever. Now to talk about some housekeeping items. If you're here to qualify for CPE credit, you must be in attendance for the entire webinar and answer all polling questions. We also request that you complete an evaluation form that will be delivered in a follow-up email after the webinar. Qualified attendees will receive 1 CPE credit within 24 hours after the webinar ends. Any questions can be sent to the marketing department at the email listed on the screen if you have any questions about the certification process. If you're wanting to receive CPE credit for attending this webinar, you must be registered and logged into your own computer to qualify for CPE. You will not qualify for CPE if you are listening in a group environment and not individually signed into the software. Also, all phone lines are muted, but if you have any questions, you can send them in via the question tool on the dashboard of the webinar. Now I'd like to go over the agenda briefly. We're going to first talk about the background behind Qualified Opportunity Zones. We're then going to talk about the list of qualifications that are required in order to qualify as a Qualified Opportunity Zone fund. We're then going to talk about some of the specifics of what make up the business property requirements, and then also talk about some of the benefits from a timeline standpoint, from a tax timeline standpoint. And then we're going to, of course, if we have time, we're going to try to address as many questions that you all have as we can. That said, I'd like to turn it over to Christy to talk more.
Thank you, David, for the introduction. Hello, everyone. Welcome, and I hope to deliver some pertinent information for you that you can take back to your communities and do good things with. So the first thing that we're going to go over is the Qualified Opportunity Zone background. This was created with the 2017 Tax Cuts and Jobs Act. The intent was to revitalize more distressed community areas with job creation and new business formation for incentivizing investment through deferring tax on latent capital gains and allowing the Qualified Opportunity Zone investments to grow tax-free. It's a great opportunity. Initially, there was a first round of interpretation through a proposed Treasury reg in October of 2018. And then they had a second round come out. There was another proposed Treasury reg in early 2019. Both of these are incorporated in the presentation. And as we go through the information, you'll realize that there are many situations that would apply to your area. And this is meant to encourage the combination of social impact and economic opportunity. So who can take advantage of qualified opportunity zones? Any taxpayer with eligible capital gains that are realizable prior to December 31st, 2026, and subsequently are reinvested in a qualified opportunity fund or business within 180 days. So the good news is this includes most capital gain property, including the sale of stocks, short or long term, and it also includes IRS Section 1231 net gains. It cannot be a sale with a related party under Section 267B. So the way that works is no more than 20% can be related party. So let's look at the timing. The timing of the 180 days window. I get a lot of questions about this. The 180 days begins when the capital gain is recognized. If a pass-through entity does not elect to defer the gain themselves by reinvesting in a qualified opportunity fund, then each individual owner underneath that pass-through entity may reinvest that capital gain that passes through to them through their K-1. The 180-day window would begin as of the end of the pass-through entity's tax year. Okay, so 12/31 is usually when that would begin, that window. The owner is allowed to elect to use the same 100-day period as the pass-through entity if that window works better for them to go ahead and reinvest that capital gains money into an opportunity zone. The timing for the Section 1231 gains, that they have to be net of 1231 losses. 1231 losses create ordinary losses. So there's a 5-year look back rule. So if you have 1231 gains later on, you have to look back at what you've taken as ordinary deductions. It's net 1231 gains. And because of that, if you're using a 1231 net capital gain, you have to use the end of the year as your year to start your 180-day window. That's the beginning of your period. So it's a good idea to keep that one in mind when you're trying to plan forward, because it's easily to forget to go look at those 1231 carryback losses. So what are the qualifications for a qualified opportunity fund? The Qualified Opportunity Fund, they use Form 8996. They self-certify that they are an organization organized to invest in qualified opportunity zone business property. They have to report annually with their return every year this form. There are 3 primary tests that have to be satisfied. There's an organization test, a purpose test, and an asset test. The organization test. So they have to be organized as a corporation or a partnership for tax purposes. That includes LLCs that make elections to be corporations or partnerships, and it also includes S-corps. They can be a public fund, so they can be an investment fund. The type of entity would depend on the same typical choices of entity that you would use if it wasn't even in a qualified opportunity zone. So the same choices you would choose a partnership versus a corporation, you still need to consider all of those. Also, the organization test, it has to have in its documents that the purpose of what it is organized for. So on the next slide, this purpose test, it must be formed for investing in a qualified opportunity zone property. So in the instructions to the Form 8996, there is an actual checkbox you have to check that says in the organizing documents, there is a provision that states that the purpose of the QOF is to invest in qualified opportunity zone property and the description of the qualified opportunity zone business. So be careful to watch the issue dates of the instructions. So when you look in the instructions for Form 8996 on the IRS's website, they're dated December of 2018. And we have had a second tranche of regs come out, proposed regs, in April of 19. So be really careful in looking at those instructions. They're probably going to update them before we get to the end of the year. But you need to be careful that you're looking at anything that was change in April of 19. The asset test. So the asset test is probably where we get the most questions. At least 90% of the qualified opportunity fund assets that are measured every 6 months on that form 8996, they have to be in a qualified opportunity zone. They have to be either business property. They can be qualified opportunity zone stock and a lower tier domestic corp, and qualified opportunity zone partnership interest in a lower tier domestic partnership. So investments by a qualified opportunity fund can be directly in business property or indirectly through an equity interest or partnership interest in another corporation or partnership. That stock or partnership interest must be acquired at original issuance for cash after 12/31/17. So here is an example of a fund structure, qualified opportunity fund structure. It's inherently flexible, and I think they tried in writing, Congress tried in writing the law to make it flexible. It can be a single structure, or a qualified opportunity fund holds the business property directly, which is where company A is directly invested in that business property. Or it can be multi-tiered, where a qualified opportunity fund holds an interest in a partnership or a corporation, possibly joint venture, that entity has multiple investors in it, and that entity holds the qualified opportunity zone business property as a part of the qualified opportunity zone businesses that are underneath it. So at this time, I'm going to pass over to David for a poll question.
Thank you, Christy. All right, we're gonna have our first polling question. And as a reminder, to qualify for CPE credit, you will need to participate in the entire webinar and answer all polling questions. So we're going to give you a couple minutes or a minute or so to answer that. And also as a reminder, if you have any questions for Christy as we move along, you can ask the questions in the question tab within the webinar dashboard of the GoToWebinar. But I can see you all are completing the polling question. I'm just going to give you a little bit longer to get that fully completed. And Christy, while we're waiting, I saw a question come through that I still see there's a certain number of people that need to finish answering the polling question. So while we wait for that, we have a question that came through. Can a corporation or partnership that is having a large capital gain take advantage of this opportunity zone investment, or is it just an opportunity for individuals? Do you maybe want to provide some of your thoughts on that?
Oh, absolutely. No, the corporations or partnerships, when they say any taxpayer, they mean any taxpayer. And corporations and partnerships are taxpayers. So and what's really nice about it is they left the opportunity for the underlying owners of some of the pass-through entities to be able to take advantage of it on their own if they wanted to as well. But you can make those investments up at the corporate or partnership level. Great question.
Great, thank you. All right, we're going to go ahead and, well, I still see some people are voting. So if you haven't voted yet, to select that option, if you just want to get that in, and we'll move forward. All right, I'm going to go ahead and close this poll. And so, Christy, the answer to, or the polling response to the question of qualified opportunity zones can be organized as, we had 4% of people say corporations, 3% say partnerships, and 93% say all of the above.
And it is definitely all of the above.
That's right. So, okay, so we're gonna continue to move on then. So take it away, Christy.
All right. So the next portion is, what is qualified opportunity zone business property? What qualifies? Okay, there's the first requirement, percentage of business property held in a qualified opportunity zone. Business property, it's generally tangible property that the Qualified Opportunity Fund purchased from an unrelated person after December 31st, 2017. It must be used in an active trader business in a qualified opportunity zone. So that one, we get a lot of discussion on what an active trader business is, and we have some more later to go through that. Then it has to meet one of either of these bullets. The original use of the property commences with the Qualified Opportunity Fund ownership. For example, the Qualified Opportunity Fund builds a new business, or the Qualified Opportunity Fund makes substantial improvements to the property after the date of acquisition. So if you have land with a building and it's purchased by a qualified opportunity zone, the substantially improved requirement is met only if within 30 months of acquiring the property, capital improvements are made to the building that exceed original cost. The IRS recently issued a rev ruling, it was at the end of 18, which illustrates that if land with a building is purchased, that it has 30 months of acquiring the property, that the fund has to make those improvements. And it has to be in an amount exceeding the total cost basis of the building only. So therefore, at a minimum, doubling the basis of the building. The adjusted basis in the land is immaterial for the substantial improvement test. So there were a lot of questions that came out about, well, how do you substantially improve land? Land's been here forever. So they took it out of the equation for original use and said it's the building and what you develop on that land. The land qualifies as business property as long as the building has capital improvement that doubles its adjusted basis, and then they allow you a working capital safe harbor of 30 months. So they came in and gave this safe harbor period where you buy the land and then you want to build it. They try to give you enough time to be able to get the investors and build the property. And I've had these questions quite a lot. So just so everyone knows, the Treasury Department and the IRS, they are looking at comments right now on anti-abuse rules for land banking to prevent abuse of just holding raw land. That's not the intent of the law. And I've had a lot of developers and different people ask me about that. You can't just buy a piece of land and put it in here. You have to develop it. There are also some things you cannot engage in as a business. Business property cannot engage in the following things: any private or commercial golf courses, country clubs, massage parlors, hot tub facilities, suntan facilities, racetracks, or other facilities used for gambling, or any store the principal business of which is the sale of alcoholic beverages for consumption off premises, so retail. I'm not sure how some of the businesses that are on this list ended up on the list. I mean, I can see where some of them wouldn't be desired in an area Congress is trying to revitalize. Others, I don't understand why. But it might possibly be to keep the individuals who already live in these areas financially able to maintain their residency there. So for a lower tier corporation or partnership, they must meet various requirements to be a qualified opportunity zone business. So that lower tier business has to hold at least 70% of its owned or leased tangible property in that zone. So it's not 90% for the business, it's 70% if it's a lower tier corp or partnership. Also, less than 5% of that business's total assets can be stock, debt, and similar non-qualified financial property. That doesn't include cash, and it doesn't include working capital while you're in that, I think that's supposed to be 30 months, that 30-month plan, acquisition, construction, the substantial improvement period. So the 70% versus 90%, people get confused with it, so I'm going to attempt to explain this. For that trader business to qualify as a qualified opportunity zone business, it must be one in which substantially all the property is owned or leased business property in the zone. The substantially all requirement is met when at least 70% of the tangible property owned or leased by a trader business is business property. So that 70% is for the businesses. It's to incentivize the qualified opportunity funds to invest more in stock and partnership interests in businesses. So if that fund invests in that business, it makes it a little bit easier for the business and how much they own. So it works in the QF's best interest to invest in stock, partnership interests, and it reduces that business property they have to hold to 70%. Qualified Opportunity Fund sale during a 10-year holding period. So if the fund makes a sale of Qualified Opportunity Zone property within 10-year period, the new regulation provides for a 12-month reinvestment period so that proceeds can be rolled into another QOZ property without the proceeds being treated as non-qualified opportunity zone property, which causes the percentage owned test to fail. So they gave them some leeway to move in and out of investments in stock and partnership. The proceeds are required to be held in short-term investments, working capital in the interim. They can't reinvest it in stocks and bonds. They have to keep it to where the intent is to look to reinvest it in qualified opportunity zones. If they did put some leeway in there that if there are delays in reinvesting due to government action, that 12-month period can be paused. And there's a lot of specifics to that I'm not going to discuss here. It does not apply to the business and their direct assets held. This only applies to the funds. So if you own a business in that area, you can't go in and out of businesses. You have to stay engaged in that business in that qualified opportunity zone area. So the intangible property. You know, sometimes businesses hold intangible property. If it's held at the business level that has a substantial portion, and they said substantial portion was 40% of it must be used in the active conduct of a trade or business. So an example of this would be if you have a programming company and a lot of their assets are intangible assets because they're developing intangibles. So what they're saying is of those intangibles, what I call them is working intangibles. They have to be a part of what you're engaged in business to do. Any intangibles held at the qualified opportunity fund level, so this isn't the business level, this is the fund level, are limited to 10% because you really shouldn't have them at that level. And you know, they can have some, but not more than 10%. So at this time, we're going to have another polling question.
All right, thank you, Christy. So the next polling question is, which of the following could qualify as a qualified opportunity zone business? Liquor store, Greyhound racetrack, apartment complex, or country club? And again, just as you'll hear me repeat this a lot, just out of an abundance of caution, but if you are wanting to qualify for CPE credit, you must participate in all of the polling questions. So make sure that you get that recorded in there so you can qualify for CPE credit. And I see a bunch of you are already quickly doing that, so I'm going to try to get in at least one question. Christy, we had a question come in, and this is probably good because hopefully we have people from all around the country participating in this. But how would my state approach opportunity zones? Can I get the same deferral and tax-free treatment from state taxes too? Maybe if you want to expand on that.
That's a really good question. Each state has their own separate laws. And so later on in our slides, we have some slides to share with you on which states are conforming to the federal law for opportunity zone and which aren't. There are some of them that have permanently decoupled from it and they do not want to participate in it. So what that would mean is you couldn't defer your capital gain at the state level if you have a state that has income tax, but you could at the federal level. So, you know, it's a very good question, and it is something in planning to do this that you definitely need to make sure you're taking into consideration.
Okay, that's great. Thank you.
Mm-hmm.
All right, we're going to go ahead and close this polling round. And 1% of people selected liquor store, Greyhound, racetrack, and country club, so 1% each, and then 97% of the respondents chose apartment complex.
So yes, definitely the apartment complex.
Right. All right, with that, I'm going to pass it right back to you, Christy.
Thank you, David. So the next qualified opportunity zone requirement is that at least 50% of gross revenue must be from an active trader business in the zone. And they've added quite a few. So trader business defined. There is no exact definition of trader business in the IRS code. Section 162A does provide a definition of expenses, but there's some controversy because the courts in the IRS pronouncements are not consistent as to the level of activity to establish the existence of a trader business. We can look to the Supreme Court decisions, which is what we do in practice in case law, that they use the notion of regularity, activity over a certain period of time, and a profit motive as factors that the courts, they've widely accepted that. So you have to have a profit motive for what you are doing to determine if it is a trade or business. And I had really hoped that, you know, when the Congress passed Section 199, the pass-through deduction, in that code, they had specifically defined what trader business was. Well, they haven't come back and done this in this one, and I'd hoped that they would. So you have to stick to profit motive and is it regular? Substantially all of the tangible property owned and leased by the taxpayer has to be business property used in an active trader business of the qualified opportunity zone business and meets the other holding requirements. So that the 50% of the QOZB's total gross income has to be active conduct of trader business. And then this also talks about the non-qualified financial property must be less than 5%. Just to be really clear, so I put it in here as a point, they were very specific in coming back and saying that active trader business does not include leased property that uses a triple net lease. So with a triple net lease, all of the expenses of the property are paid by the person leasing. That lessor has to be providing a service to be able to say they're in an active trader business for this part of the law. So they have given us some income safe harbors, so 50% of gross income safe harbors, which is nice. This came out with the second tranche of regs. You have to satisfy one of the three below. So 50% of your services performed based on hours by employees or independent contractors are performed in the zone. At least 50% of the amounts paid by the business for services rendered by employees or independent are performed in the zone. The tangible property of the qualified opportunity zone business is located in the qualified opportunity zone, and the management or operations functions performed in the qualified opportunity zone are each necessary to generation of at least 50% of the gross income. So if you have like a corporate headquarters that's located in the zone and 50% of the revenue, and let's say your sales force is in that area and they generate over 50% of the gross income from that sales force in that corporate office, that would qualify too. So they tried to give us a couple of safe harbors that we can use to qualify for this 50% test. So at this time, we're going to have another polling question.
All right. The Internal Revenue Code is clear cut about trade and business income. It's just a true or false question. And while that's coming through, while those are being populated, Christy, depending on the nuances of some of these answers, they may be required to follow up with some of these attendees afterwards. But in the off chance that you can answer some of these offhand,
Okay.
we have a few questions. Let's see here. If a government owns the land, could a P3 public-private partnership project in a qualified opportunity zone be eligible if a developer builds the actual building structure?
If that building is held in a separate entity, so they own the land and that developer is building that property, and that property is inside of a partnership or a corp that elects to be a qualified opportunity zone property, but you have to have a business that's going to be run in that building when it's done. So it qualifies for original use, but you have to make sure there's a business that's being run in that property.
Okay, great. Maybe somewhat on a somewhat related note, talking about the raw land, is there a minimum amount to invest in improvements after the purchase of land?
So if you buy raw land, right, the land is not included in the original use test. So it's whatever you develop on it, you have to substantially improve, which means double its value. So if it had nothing on it, you just have to improve 0. So, but you also have to remember whatever you're building on that land has to qualify for the 50% active trader business. So you have to build something that can be a business once it's done. I hope that answered.
I think so. I think you did a great job. And just a quick reminder, if you're on this webinar and wanting to qualify for CPE credit, you must be in attendance for the entire webinar and answer all polling questions. So if you haven't answered the polling question yet, please do so. And let's see here if we can get in one more before we close this poll. Now, what if someone doesn't invest all the funds within the prescribed time frames? Are there any penalties other than paying any taxes due, or is that something you can elaborate on?
If you don't pay within the 180-day window, then you can't defer the capital gain. So yeah, you have to do it within that time frame, and otherwise you're not able to defer the capital gain going in, which you have to do the deferred capital gain in order to, what we're going to go through the rest of this, in order to get the benefits of the rest of it. So
Okay,
the window is important.
Yeah. All right. Well, let's see here. We're going to go ahead and close this poll and have a little bit of a mixed response. 26% of the attendees said that the Internal Revenue Code is clear cut about trade and business income, true, and then 74% selected false. So a little bit of a mixed interpretation.
Right.
But with that, we're going to move it back to you, Christy.
Okay. All right, so now we're going to go through the Qualified Opportunity Zone tax benefit and a timeline. So what are the tax benefits? The provision provides 3 tax benefits for a taxpayer who has a capital gain from the sale or exchange of property with an unrelated person in late 17 through 2026. If the taxpayer invests an amount equal to the capital gain, or more if desired, in a qualified opportunity zone during the 180-day period beginning on the sale or exchange date. There's 3 things that you can benefit from. There is a possibility of permanent exclusion of up to 10 to 15% of the deferred capital gain, so that beginning deferred capital gain. There's also a deferral of the remaining original capital gain until December 31st, 2026. And there is a permanent exclusion of gain from any post-investment appreciation in the Qualified Opportunity Fund if the interest is sold or exchanged after being held for 10 years or more. Now they have a cutoff in the law right now of 2047. So you'd have to sell it before 2047 and hold it for 10 years. So we're going to go through an example. So we have an investor who has a capital gain of 10 million from a sale. without the opportunity zone, the investor may be faced with a 20% capital gains tax of $2 million in the year of that sale. Now, for simplicity and explaining purposes, if this is an investment and they're not active in it, they may have been subject to 3.8% net investment income tax too. So it might be 23.8%, but to keep the example simple, I'm keeping it at 20%. If the investor elects to reinvest the $10 million into a qualified opportunity fund, they can defer that $2 million gain. They can invest it in either a business. The fund can use that $10 million to invest in a qualified opportunity zone business or qualified opportunity zone business property. So here's some comparisons. If the investor sold their qualified opportunity fund investment for $20 million after holding it for 5 years, the basis of the investment would increase by 10% of the original capital gain deferral of $10 million. So 10% would be $1 million. So you would take the $20 million that they sold it for, $20 million they sold it for, less the $1 million of basis they're getting given, and they would have a $19 million capital gain on the sale of that qualified opportunity fund interest. So if they hadn't done the deferral, they would have had a $20 million capital gain across those two transactions. So on the next side, if the investor sold their qualified opportunity fund investment for $20 million after holding the fund for 7 years, the basis of the investment would increase by 15%, giving them $1.5 million of basis. So that would create an $18.5 million capital gain when they sold their qualified opportunity fund interest. So that's the 10 and 5%, that's the deferral, that the permanent exclusion that you would receive. So capital gain recognition on 12/31/2026. This is a hard date. Everybody has to live by it. The original capital gain that you deferred cannot be deferred past 12/31/2026. Even if you decide you want to continue to hold that investment, you have to pay the tax on that original deferred capital gain come 12/31/2026. I can't say it enough. You have to make sure that you have the cash set aside to pay that capital gains tax, especially if you know you want to try and hold the property or investment longer. So it's definitely a planning point that I stress with clients, because I know it come 2026, I'm going to have people say, I don't have that cash. So we're making sure in our planning documents that they know they have to have it set aside. So assume the 10 million capital gain was deferred in that qualified opportunity fund investment. When they reach 12/31/2026, if they've held it less than 5 years, they recognize a $10 million capital gain and they have no tax basis because they didn't hold it more than 5 years. If they held it more than 5 years but less than 5, they have a $9 million capital gain and they have a tax basis of $1 million, but they have to recognize that $9 million if they're continuing to hold the property. And then for 7 years, they have to recognize a capital gain of $8.5 million, and they're given a tax basis from the permanent exclusion of $1.5 million. So at 10 years, they've held that investment for at least 10 years, and they make an election, the taxpayer will be able to have a basis equal to fair market value of the investment on the date of sale of the investment. So they're basically getting a step up. So in this chart, if the QF investment is held for at least 10 years and the taxpayer makes an election, they can have a basis equal to fair market value of the investment on the date of sale of the investment. So if they hold it for 10 years, they wouldn't have to recognize gain on any post-acquisition appreciation on the investment. The QOF is held at least 5 years by 12/31/26. They have a permanent 10% basis adjustment that applies. 90% of the deferred gain is recognized on 12/31/2026. If they sold or exchanged after 12/31/2026 for fair market value, after being held for at least 10 years, they will recognize no additional gain because of that fair market value basis election, that step up, even if the investment has increased in value from 12/31/2026 to the date that they dispose of it in the future from there. So the really nice thing is they're giving you some leeway in the appreciation and not having you pay the additional tax on that appreciation. So we have an example, because I always get down to how much tax are we paying? And that's what helps me to see the numbers. So here are the facts. Annie has a capital gain of $10 million and successfully invests in a qualified opportunity fund on December 31st, 2019, meeting all of the technical requirements on December 31st, 2026. Annie is still holding the qualified opportunity fund and taxes due. How much tax does Annie pay? Annie has held the fund for 7 years at that point. She gets to take advantage of an increase in her basis by 15%. Therefore, she's only going to pay tax on $8.5 million at that point of that deferred capital gain of $10 million that she had prior to her investment. This results in a tax liability at the 20% rate of $1.7 million owed, and she has to pay it at that point. So that's what I mean by you have to have the money set aside if you want to hold it to that 10-year mark, and it's after 2026 that you hit it. So if Annie continues to hold the property past December 31st, 2029, so past the 10 years, and then sells the property, she pays no additional tax on the sale. So let's say she sells it for $20 million due to appreciation of the assets. She would have otherwise had a capital gain event of $11.5 million. So the $20 million purchase price less her $8.5 million basis, because she did pay the $1.7 million in tax, she gets basis for that, would equal $11.5 million in capital gains. But Annie's going, because Annie's a smart girl, she's going to elect to treat the basis as fair market value at the date of sale. So she would have owed $2.3 million more in additional capital gains tax if she hadn't made that election, and it's eliminated. So in reality, she's only paid $1.7 million of tax for $21.5 million in capital gains, which is effectively 8%. So, 8% is a lot different than 20%. So as you can imagine, the greater the appreciation on the original investment, the larger the tax savings. And this is the part where people get incentivized. This is where if you have something long-term and a long-term business, and I think this is Congress's intent of getting these investments to stay in those areas too. They are incentivizing it. So this is the example we went through. So we also have a timeline. This timeline it's an easy tool to pull out. I think we're going to give this to you separately also, so you can download it and use it to help you go through the dates and kind of follow through. I use it to kind of track. I like to, when I sit down with a client, I like to plan out the timeline of when things are going to happen, just to make sure we all understand what the triggers are and what the milestones are. It will help you in your planning. So I encourage everyone to use this. And then there are triggering gain there are points that you could trigger gain, or if you're exiting the QOF, where you can cause the tax to happen. So the deferred gain is recognized that, we've already talked about this, earlier of 2026 or when it is sold. Gain recognition is triggered when direct equity in the fund is reduced or a portion is distributed or cashed out. So if either of those things happen, you can trigger that deferred gain to be recognized. An example of that would be a sale of a partnership interest that owns an interest in a QOF, a termination of a QOF. So if the QOF becomes unqualified, if you gift your interest in a QOF, an S Corp conversion or a C Corp redemption. Also, there's non-recognized gain events, which is nice that they told us what these are. If you have a tax-free corporate liquidation of subsidiaries, if you have a transfer at death, so if you get it in an estate, it'll still hold. Contribution to a grantor trust, Section 721 transactions, and making or revoking an S election. So you have to be careful. Those you can use, those events are fine, but you have to be careful anytime that you're reducing the equity or terminating an entity or gifting, you have to be very careful. Now, there are differing rules that apply to the partnerships and the S Corps. One of them is within the partnerships, if you are leveraging debt basis, so let's say you have, as a partner, you have put loaned money to the partnership, or you are you're getting basis for the debt inside of the partnership. It's a great tool, but it needs to be watched closely. Debt basis, it can be used to take current year deductions like depreciation, and if the property is held to the 10-year mark, the property gets stepped up to fair market value, so then you don't have any recapture on that depreciation that it would have to be included in ordinary income potentially. The caveat to this is if the debt base is reduced while holding the qualified opportunity fund investment, that could reduce the partner's equity interest, which could trigger recognition of part or all of the deferred gain. So you have to watch those basis calculations. And when those transactions happen and those triggers happen, the amount of inclusion equals the excess of fair market value multiplied by the deferred capital gain, or fair market value less the taxpayer's basis, which usually if you've held it less than 5 years is going to be 0. So it does prorate, but it depends on what triggered that gain. So with that, I'm going to pass back to David for a poll question.
All right, thank you. So let's see here. The next and last polling question is, which of the following could trigger gain recognition? Please select one. Filing your 2026 tax return, gifting your qualified opportunity zone fund to your children, qualified opportunity zone fund sells property and liquidates, or all the above. And while we are I'm having that filled out, we do have some questions, and I noticed a couple themes with a few of these questions. The first one, Christy, capital gains due at 12/31/2026. Can you maybe clarify, is that at whatever capital gains rates are at that applicable time, or is it the capital gains rate when when the investment first occurred?
That's a really good question. That is actually a really good question. There's been a lot of talk about that. I think when they did the last set of proposed regs, they went back and forth. I think that was actually one of the questions that were proposed to be talked about. And when the IRS came out with the proposed reg, they didn't address it. They are saying it is the tax and when you actually have the capital gain. So you can't go back to when it actually happened. You have to live with when the gain gets triggered. That's the year that you have to follow that law for what capital gains tax is. So there is a risk in that Congress will change what the capital gains rate is. And if they do, there is an inherent risk in there that it could go up. But good question.
Okay, yeah, great. As with anything, any of these decisions or opportunities, there's some opportunity for award there, and there's some inherent risk with any of it.
Right.
So let's see here. Another theme with as far as some questions is, are there any rules regarding purchasing or improving opportunity zone property without having rolled in or deferred a gain? Can you do it just a straight new investment?
So everything that I've read, and if you look at the question and answers on the IRS's website, they have one question that does address that in a way, and it says that if you defer the gain, you have to defer the gain to be able to qualify to get the rest of the benefits. So, you have to have deferred gains to push into that. in order to be able to take advantage of the rest of them. They are not two separate transactions.
Gotcha. All right, let's see here. Just confirming, for a qualified opportunity zone fund investment made after 2019, the 7-year 15 incentive is unavailable?
Yes, if you do it after 2019, yes, that 17 falls off because of when 2026 happens. I don't like to pressure people about that because, you know, while you don't get to take advantage of it, you still need to be very careful to make sure that you are taking the time to do your due diligence and making sure it's a good investment. But yes, once we get past the end of 2019, that 7-year exclusion falls off.
Okay, great, thank you. All right, we're going to go ahead and close the polling question. And the predominant response of what would trigger the gain recognition, we had 16% say when the property sells and liquidates, when the fund sells property and liquidates, but then 79% of you all selected all of the above. So with that, I'm going to pass it back over to you, Christy.
Perfect. Okay, as promised, we have the state tax implications. So on these two United States of America, we have corporate and individual tax at the state level. So the very dark blue is conforming states that their laws will follow along with the federal, so you'd be able to defer the capital gain. The lighter blue is they're conforming, but they did it on a fixed date, so you definitely need to drill down and go find out what the date is in that state that they're allowing it. The darker orange is the no capital gains states, so you don't have to worry about it. And then the lighter ones are the states that aren't conforming. Some of them are in talks about it and may change. 2 of them I know have completely decoupled. So they've said, no, we will not follow the federal law. So you, in those states, you would have to pay the capital gains tax at a state level, but you'd be able to defer it at a federal level. So always a good thing to go and see the states, what states you're dealing with. The other thing you need to take into consideration when you're thinking of states, you have to think of where the business is and what state that's in, but you also need to think about the residency state. So the taxpayer who is an investor, it depends on the state that they are a resident in also. So you may have 2 states' laws you need to be looking at when evaluating it. So where are the QOZs? So all the little dark blue marks on here where the qualified opportunity zones are. There's a number of them across the country. You can check our CRI opportunity zone page under trends to find links where there's links to opportunity zone maps, articles, lots of other resources. If you have a local project, a great resource would be your local city and county governments. The economic development, planning, and zoning departments, they're the best resource in determining if an investment aligns with the area plans that the government has. Some of them have actually come up with prospectuses of what they foresee could go in those areas. So it's always a good idea to go and talk to them. Each county and city that I've sat on some of these presentations that we've done from the local areas, along with, they always come with other suggestions of other incentives that they compare with it, that they feel are available to anybody who's going into those areas. If you're an individual investor, you know, there's a lot of rules, as everyone has just seen. That might be better to go into a qualified opportunity fund. The investment brokers and the investment houses have a lot of these funds. I would let them make sure they're following these rules. So it might be better to invest in that. If you're going to do this on your own, it is complicated, and you definitely need professional help with it, legal, accounting. You know, make sure that you're getting the right people at the table to make sure you can make this work. And with that, I want to thank everyone for listening in, and I am going to pass it over to David.
Great, thanks, Christy. And just everyone, we're going to have a few more points that we want to talk about, and then we are going to answer maybe 3 to 4 questions depending on the involvedness of them before we go. So we would encourage you, if you have not yet connected with CRI, to connect via one of our social media platforms. You'll be kept in the loop in terms of any upcoming discussions and also pretty constant information about timely topics and new tax and accounting changes that may affect you. Along those lines, we have a few upcoming webinars. In October, we have a webinar that applies to financial institutions regarding CECL, so the current status and next steps for financial institutions. And then November, as we already approach toward the end of 2019, we're going to be having a couple year-end planning discussions. One that is exclusively based on tax benefits and planning opportunities for individuals, and then another that is revolves around tax planning and opportunities regarding businesses. So if you have any interest in those, we encourage you to sign up because space is limited. I'd like to thank you again, myself, David, and Christy, the presenter. We now are going to talk about a few more questions. Let's see here, Christy, if you're ready.
Okay.
I had a couple questions. I had a couple questions that revolved around refinancing. Can you finance your project and then pull out cash after the 30-month window?
So no, when you pull out that cash, right, if it causes your equity to go down, right, if it causes you can have distributions out of a lower tier entity. But if you have a QOF that has an investment, if there's ROI, right, you can pull that cash out. But if you start diminishing the equity basis, that can trigger the deferred gain to have to be recognized. So it is a little tricky, and that's why I tell individuals, if you're going to do it, you really need to be working with the investment broker houses and let them make sure that all those things are working to your advantage.
Okay, great. We had another question regarding the apartment complex example. Does an apartment complex qualify as long as it doesn't use a triple net lease? Do you have any thoughts on that?
Yes, right. So, an apartment complex, you generally have an office that's with it. You have to be providing services to that property. So if you take care of the lawn care, the maintenance, the pool, laundry rooms, all those things, you're providing other services, right, to that property. That it makes it active. If it's a commercial building and it has a triple net lease, it means the person that is renting out of that space, they're paying all the other expenses and a CAM and all those things. So when they wrote this, what they're saying is you really have to be providing a service, creating jobs in those areas. That's the whole intent of the law.
Great, thank you. What about, this is maybe something related to earlier in the presentation regarding some of the structures, but what if a trust, is gain recognized if a trust owns, say through a partnership interest, the qualified opportunity zone asset and eventually it is distributed to beneficiaries? Is there any insight to that layer of that structuring?
That's a really good question, and I'd have to go look that one up because you can't move it into a grantor trust, but if it goes to where it gets distributed, that might trigger it. I would actually have to go look at that one and double check. If you want to send that to me, and I'll look at the April regs and the October regs, and I can get an answer back to that person.
Sure, great. Let's see here, try to find one more. What about if the property is acquired prior to January 1st, 18 and improvements done after January 1, 18? Does this qualify or is there a limitation there?
They have to acquire it after 12/31/17. So if they already own it, it can't be sold between related parties either. So, if you already owned it, then you can't defer gain into the rest of it. Now, I would say seek legal counsel because you may be able to put them in two separate entities if you're going to build something There's been some creative ways that I've seen that people are trying to address that, but if that original purchase has happened prior to 1/1/18, then it doesn't qualify as business property for a zone.
Okay, great. And maybe I want to be mindful of everyone's time. What about, again, a kind of question regarding some refinance discussion. Can you refinance the property to pay the taxes in 2026? Is there any availability there, or is it all independent of that?
You know, it all comes down to in refinancing and pulling cash out, are you causing your equity to go down in the entity? So it's all about your basis in that entity. And when you cause that, that's what triggers that gain. So all good questions, and definitely you have to think about that if you pull enough cash out that it causes your basis to go down, that triggers a gain. Now, at that point, you know, it's just a deferral gain, the deferred gain that's being triggered. So it may not be as big a deal, but you do need to make sure that you're following the partnership or S corp rules as well about if you pull out too much and make your equity go negative, am I triggering a gain under the normal rules of an entity? So definitely something to plan out and look at. It's possible, but you have to make sure that you're not triggering a gain in normal circumstances. So, but that's a good question and a good point, because at 2026, it's already getting recognized. If you need the cash to pay the taxes, you could, but you need to make sure that you're not causing capital gains by causing your equity in the entity to go negative.
Great.
Yeah.
Okay, let me see. Let me try to get a couple that might be a little bit easier to answer quickly. Is there a, when we were talking about the types of businesses that would qualify, would you suspect that a child care program or wellness facility, that those would qualify to be that a qualifying business activity?
Absolutely. If they're in the zone, I mean, that's actually probably a really good one. Because if you think about it, businesses that can go in those areas, these are disadvantaged areas, and businesses that have jobs that people who live in those areas can do. So those are great ideas. They're active trade or business. They're very active. Daycares are definitely active. And there's people in those areas that those would be great jobs for them.
Great. Well, I think let me see. I think there's one other question that you can probably answer pretty quickly, and then we'll close it. How long do you have after investing the funds in the Opportunity Zone Fund to have to close or purchase the property? This gets back to kind of maybe the original formula for how this whole opportunity works.
So once you put the funds into the QOF, I think that's the 12, no, I think that's the 180 days. I mean, they have to be invested. But I can go back and double check on that one, because you know that the original investor has the deferred gain and they go into the QOF. The QOF, they may have a 12-month window. I'd have to go look.
Yeah, and if that doesn't happen,
and then they have the working capital. They have the 30 months. If they're building or they're creating something, they have the 30 months for working capital.
Great. Well, as you mentioned before, it is, to reiterate it, it is a very complex area, and we are fortunate at CRI to have experts such as Christy to help people navigate this complex area. We have our contact information on the slide, and this webinar will be available as well as the handouts after this webinar is concluded. If you want to refer back to any of the slides and any of the details, you will be able to. And we would like to thank you again for attending today. And we hope that you connect with CRI on social media and that you will join us on one of our upcoming webinars later this year. So thank you very much. Thank you, Christy.
Thank you.